So you decided you want to take that next step from moving on from ETFs and mutual funds to investing in individual stocks. I'm proud of you. Now, this is a big step in your investment journey, as many people don't get involved with individual stock picking. As we talked about in my earlier video, my beginner's guide to investing in the stock market in 2021, individual stock picking is a great choice for those of you who are willing to take on more risk and who feel confident in picking the winners out of the stock market. Great companies I'm sure you've heard of, like Disney, Apple, and Microsoft, have all done really well and outperformed the market. Now, beating the market just means that you're getting a higher return than you would by investing in an individual index, like the S&P 500. Now, I know individual stock picking might feel a little complex and a little overwhelming. However, it doesn't have to be like that. So in this video, I'm going to be talking about the process and methodology that I use when picking individual stocks. Now, I'll be talking about the key metrics and ratios that you should be looking at, as well as the business and bigger side of things. I'm going to be walking through all of it today, so sit back, relax, and enjoy the video. Now, as a quick disclaimer, you should invest in stocks if and only if you have the time and desire to thoroughly research and evaluate stocks on an ongoing basis. If this is the case, then I 100% encourage you to do so, as it's entirely possible to beat the market through patience and dedication. So great, with that out of the way, let's talk about actually investing in an individual stock. Now, when you invest in an individual stock, you're actually buying a share of the company. So you're directly owning a part of the company. Now, Warren Buffett famously said that you should buy into a company because you want to own a part of the company, not because you want the stock price to go up. And I think that's really important for you to remember. Now that you know this, let's talk about actually finding different companies. Now, there's tons of companies out there on the public market. If you see a product in your personal life that you're a really big fan of, all you have to do is look up the product's name and type in stock. You can find out if the stock is publicly traded, and if it is, you can start doing your research. Now, another way to actually find out about different stocks is actually going through the different indexes. Now, there's the S&P 500, there's the Dow Jones, and the NASDAQ 100. You can parse through this list and find out different stocks that call out to you and that you believe could be a good investment opportunity. Now, a public company always has an investors relations page on their company website. Now, the investors relations page has a whole bunch of information regarding their stock, most notably their investor presentation, as well as their annual reports. Now, their annual report is called the 10K, and the quarterly report is called the 10Q. Now, this is the first step that I take for learning about the company. Now, in these reports and presentation, the company provides a lot of information, what they're all about, their financials, their business strategy, and much, much more. Another good way of initially learning about the business is to listen in on the earnings call. Now, every quarter or every 3 months, the company reports the quarterly earnings. Now, these companies have this call to break down exactly what's happening with their business and how well their financial performance was over the last quarter. I know it's pretty tedious, but it's very important for you to do this initial research to really understand what the company is all about. So great, now that you know what the company is all about, now it's time for us to do a 2-step process. The first one is quantitative research. Whoa, Kenny, slow down. Quantitative research? What's that? Now, quantitative analysis is a method in finance for using both mathematical and statistical analysis to be able to value a stock. So that's fancy talk for just looking at the numbers. Now, financial reports have a lot of different metrics and numbers, so it's pretty easy to get bogged down with this. Now, it's important to zero in on the key metrics to understand the inner workings of the company. Now, the first one is revenue, and that's how much money they're making in a given period. Revenue is the first thing that you see on the income statement, so that's why it's called the top line. Next, we have net income, which is the very last line of the income statement. That's why it's called the bottom line. Net income is the total amount made after taking out operating expenses, depreciation, and tax. So now that we have the revenue and net income, we can start talking about how we can start doing valuation metrics on this company. Now, one of the first key metrics is going to be EPS, or earnings per share. This number shows a company's profitability on a per share basis, so it makes it easier to be able to value this company against other companies. To do this, you divide the earnings by the number of shares outstanding, and you get their EPS. When you see earnings per share followed by a TTM, that means trailing 12 months, so it's over the 1-year period. Now let's talk about the price to earnings ratio. Now, this is one of the most popular ratios that investors use to value a company. This measure of the stock's value tells you how much investors are willing to pay for $1 of the company's earnings. Now, dividing the stock price with the forecasted earnings given by Wall Street analysts give you the forward earnings, so it's forward looking over the next 12 months. Now, I personally like this metric because I like understanding how the company is going to be valued over the next 12 months. Now, the PEG ratio goes one step further than the price to earnings ratio. It factors in the projected rate of growth for earnings, so this might be a better indicator than just looking at the past 12 months earnings. Lastly, we have return on equity and return on assets. Now, return on equity reveals, in percentage terms, the amount of profit that a company is able to generate through shareholders' equity, or with each dollar that the shareholder has invested. Now, return on assets shows in percentage terms how much a company is able to generate a profit through each dollar of its own assets. Okay, so you're probably asking, okay, Kenny, now what about stocks that don't have any earnings? How do we value these companies? Well, it's a great question, and best way to do this, in my opinion, is using the price to sales ratio. Now, the price to sales ratio is calculated by taking the company's market cap, or the number of outstanding shares, times the price, divided by the revenue over the past 12 months. Now, the lower the price to sales ratio, the more attractive the investment. Makes sense, right? If you're buying a company that has a price to sales at 2, compared to a company that has a price to sales of 4, you're essentially able to buy this company that's doing twice as much sales as the other company. On the flip side, we have price to book. Now, price to book compares a company's market cap divided by its book value. Now, a company's book value is the carrying value that it has on its balance sheet. Now, there's 3 main financial statements that you should look at when judging a company's financials. Now, the first one is the income statement, which we talked about earlier. The second one is the balance sheet, which judges a company's overall health. The third one is a cash flow statement, which tells you the kind of cash that's being generated by the company and being put out. So with the balance sheet, we're taking a look at the company's assets and liabilities. So overall, the health of the company. Now, there's a few key ratios that I like looking at. The first one is a current ratio. Like the price to earnings ratio, the current ratio is one of the most popular financial ratios out there. It serves as a test of a company's financial strength, and it can give you an idea whether or not a company has too much or too little cash to be able to meet its obligations. It's calculated by dividing its current assets over its current liabilities. Generally speaking, you'd like to see a current ratio over 1, as it means that they have more current assets than current liabilities. So they're able to pay off all their liabilities while still having some cash left over. Now we have the quick ratio. The quick ratio is very similar to the current ratio. However, it subtracts inventory from the current assets. This is because a company might need to take a lot of time to be able to liquidate their inventory, to be able to get the cash, to be able to cover their liabilities. Lastly, not as important, but still something I wanted to add in, is the margin profile. By their margin profile, I mean their gross profit margin, their net profit margin, and their operating margin. Now, this tells you how much a company's profit is available as a percentage of its revenue to meet the company's expenses. It's calculated by subtracting the cost of goods sold from their total sales and dividing that by their total sales. Next, we have net profit margin. And net profit margin tells you how much a company makes for every $1 in sales. So take, for example, a company with a net profit margin of 0.14. This means the company makes 14 cents in profit for every $1 sold. Ooh, that was a lot, I know. But now we can move on to the next part. Now let's talk about qualitative research. With qualitative analysis, you can think of quality. But with quantitative analysis, you can think of quantity. So now that we know that quantitative analysis is more for financials and qualitative analysis is more for the big picture, let's dive into it. Now, one of the first questions you should ask is, how does this company make money? I know this seems like a really simple question, but it's really important for you to understand that. A good rule of thumb is to invest in common sense companies that you truly understand. Now, what I like doing is the elevator challenge. So what this is if I'm not able to explain a company or pitch it to someone else in the length of an elevator ride, it's probably not a good investment. Next, I like to ask, does this company have a competitive advantage? Now, I really like to focus on companies that have an unrivaled value proposition. Now, I like looking for companies that have a big differentiator, whether that's a very strong brand, innovative technology, or operational efficiency. The harder it is for other competitors to breach the company's moat, the better the opportunity is for this company. Next, I like to ask, how good is the management team? It's really important, especially in smaller companies, to take a deep dive and understand who their CEO is, as well as the whole entire management team. Now, I'm currently reading this book, Good to Great, and it talks about how some companies make the leap from good to great and how some don't. And one key thing this book talks about is how important it is to have a solid management team. Jim Collins wrote, "The executives who ignited the transformations from good to great did not first figure out where to drive the bus and then get the people to take it there. No, they first got the right people on the bus and the wrong people off the bus, and then figured out where to drive it." So what I like doing is going on Glassdoor or Indeed and looking at the reviews of the company overall. I like to see what other employees are saying about their management and the company, and it gives me a good feel of what the culture is at that company. Lastly, I like to ask, what could go wrong, and dive into the risk factors. I try to be as skeptical and critical as possible when looking into a company for any big red flags. I think this is one of the most important parts that people forget about. I'd like for you to be the biggest critic when doing research because I want you to fully understand the risk factors before investing into the stock. So as you can see, there's many different factors that you need to look into before investing in an individual stock. Before you buy any stock, you want to build a well-informed narrative or a bullish thesis about the company and what factors make it worthy of a long-term partnership. Now, I want you to think of this as a partnership, that you're directly helping the company that you're investing in. I personally think it's important for you to invest in a company that not only excites you, but also keeps you active from keeping up with the company. Now, I'm a big proponent of long-term investing. So before you buy into the stock, imagine you holding it for the next 5 to 10 years. I believe that you should invest in the future that you believe in. In that light, I think it's important to look at the industries that you believe will do really well over the next few decades and invest in some of the best companies that are in these industries. So a few tips before I wrap everything up. I think it's really important for you to continue to diversify your portfolio. It's not recommended to go too heavy into one individual stock, as you never really know what could happen. Now, for me personally, I don't have anything over 15% into one stock in my portfolio. However, I know that ranges from about 10 to 20% for a lot of people. I talked about this earlier, but you should only invest in companies that you understand. So when shit hits the fan and the stock starts plummeting 20, 30%, I don't want you to panic sell. I want that to be an opportunity for you to add more in and to average down your cost basis. As Warren Buffett famously said, the stock market is a device for transferring money from the inpatient to the patient. Next tip is to avoid penny stocks or other high volatility stocks until you get the hang of investing. Now, if you're just starting out, I highly recommend to invest into blue chip stocks to get the ball rolling. Now, blue chip stocks are typically large cap, established, stable businesses that might not be setting growth records, but are financially sound. Some of these, for example, are Apple, Home Depot, Disney, and the list goes on. Now, is it a good time to buy stocks, especially with markets at all-time highs? Well, the truth is, you don't know, and I don't know. No one really knows. But if you have a long-term time horizon of about 5 to 10 years, I believe having your money in shares of an individual company that is continuing to grow is much better than having your money just sit in cash in a savings account. So how will I know when to sell stocks? Now, that's a really good question, and that really depends on your financial goals. For me personally, since I'm younger, I'm planning on just buying and holding. Now, the only reason I would sell is if a current holding gets too large, over 15% of my overall portfolio, then I would start trimming. Another reason is if the company's business strategy starts changing and I don't want to be on board. I would almost never sell due to volatility. However, I would sell if their overall business has changed. Lastly, if I do want to sell, I try holding over 1 year as I don't want to get hit with capital gains tax. Now, capital gains essentially means you're getting taxed on the gains that you make if you sell a stock within less than 1 year. And this tax rate is much higher than it is if I just held for over 1 year. So one important thing that I like to stress is only invest money that you don't need for the next year or so. If you don't need the money immediately, it'll help prevent you from selling either at a loss or selling before the 1 year, which you'll get hit with a higher tax rate. With that, guys, you should be well on your way to picking individual stocks. So I know I threw a lot at you, so feel free to take your time and do more research after this video. Once you start putting this into practice, you'll start gaining the confidence and skills to be able to start being a great investor. So with that, guys, thanks as always. I hope you enjoyed this 2-part series where I talk about how to invest in the stock market. Now, if you're more experienced, consider sharing this with loved ones that have no experience with the stock market. Hopefully this could be a good resource for them to help motivate them to start investing in the market. Thanks, guys. I'll see you in the next one, and let's go get that bag.